Nvidia revenues surged 78%, but is that enough to silence investor worries about massive AI spending? Demand from Microsoft, Amazon, Alphabet and other tech giants for advanced chips is still booming, according to numbers posted last night by the chipmaker Nvidia. It's ramping up production of new chips despite the shock in January when China's DeepSeek unveiled a seemingly much cheaper model. The market, though, isn't all that impressed. Nvidia's shares are actually lower in overnight trading. Altaf Kassam is Europe Head of Investment Strategy at State Street Global Advisors. Altaf, these worries then about whether big tech companies have spent too much money on AI haven't quite gone away then, have they?
Yeah, good morning, Elena. It's a really interesting time at the moment for AI. I think what we're going to see and what the start of the year has proved is that this is going to be a year when AI technology kind of diffuses away from being all about the huge names with $100 billion of capex, and there's only really one chip in town, to a much more broader adoption of AI through lots of different industries outside of the US as well, outside of the mega caps. And I think this is what we're starting to see and have seen in the last few weeks. And I think DeepSeek was really a wake-up moment for that.
Are the mega caps, though, going to have to quite soon demonstrate to their shareholders a concrete case for why they've spent so much money, especially if DeepSeek is able to produce things more cheaply?
Yeah, I mean, absolutely. So I think we're going to get a two-tier kind of system where you're going to have the mega caps developing ever more powerful models built on much more cutting-edge technology, which they're going to sell to corporate customers and deploy at higher margins. And then you're going to get, like I say, this diffusion, which is going to be less reliant on the cutting edge technology, which is going to build off what's already been done before, and which frankly is going to be good enough for a lot of industries and a lot of uses. And that's where we're going to see the use of AI being spread out. So I think we're going to get a bit of a two-tier system developing.
Altaf tariffs, of course, are back in the headlines. President Trump threatened a 25% duty on EU goods on Wednesday. Now, none of these tariffs have yet materialised, but they are making the market nervous, aren't they?
Yeah, so I mean, Europe was being naive, and the way the European market rallied through the start of the year was a bit head in the sand, in the sense that we all knew that Trump had Europe in his crosshairs, and it was only going to be a matter of time, and that time has come. And we're seeing an immediate reaction. But frankly, as we've seen with other countries, and obviously talked to Trudeau in Canada and Sheinbaum in Mexico, there's a lot between Trump saying something and something happening. And we even have confusion about dates, even to the extent of is it this month or next month. So I think there's a lot of room on the road. There's still a lot of room for negotiation, which is Trump's preferred policy. But Europe was being naive, and European investors or investors in European equities were definitely being naive to think that we had kind of somehow escaped the Trump tariff approach.
As you say, European stocks have actually done better than the US thus far this year, as investors had bet heavily on American exceptionalism, and they're unwinding some of those trades. Why is that?
Yeah, I think it's less a case of the America's exceptionalism fading fast, and more a case of Europe catching up. And finally, there are some green shoots that we're seeing in Europe. We've seen the growth numbers improve slightly, PMIs, consumer confidence. So it feels like Europe may have finally troughed. At the same time, we are seeing a little bit of weakening in the US numbers as well. Again, PMIs have come off, especially in manufacturing. So there's a bit of a convergence going on, but it's not all bad. It's not that the US is coming off sharply. It's more like Europe is catching up at the moment.
How much, though, do you think investors should worry about US consumer demand in particular being hit as prices rise, and especially with those tariffs?
It's definitely a concern. What we have seen is that the huge spike in confidence that we got post the Trump election victory has really started to come off. And we're seeing, especially from smaller companies, that the investment plans that they had kind of put on the shelf ahead of the Trump election are now being quickly taken off. So if there is a stall in spending, and especially if inflation expectations start to pick up, that would be bad for consumer spending. So it's that kind of data that we're looking for at the moment. At the moment, so far, it's really been a lot of soft data, and we need to see if anything is affecting, for example, the jobs market, which would affect the path of monetary policy.
That was Altaf Kassam of State Street Global Advisors. Don't forget you can watch more videos on Reuters.com.